In today's episode of the MSA Rental Market Update, we are looking at the Charlotte rental market for multifamily properties. So as you can see, the Charlotte, North Carolina metro statistical area has been drawn here by CoStar. You can kind of get an idea of where it is along the East Coast. We've got Raleigh, North Carolina over here. We have Richmond, Virginia, Norfolk, Virginia over here. Wilmington, North Carolina, Myrtle Beach, Charleston, Atlanta's over here. Nashville is over here. We got Birmingham, Alabama over here. So this kind of gives you an idea of where the Charlotte-Mecklenburg area is, or the Charlotte metro statistical area. So as always, let's go take a look at our filters and see what we are excluding. So we will be excluding all corporate, all military, all senior, and all vacation as usual. As well, we will be including only market and market affordable so that we are only looking at conventional apartments. When we go to location, you can see that we have market selected, metro statistical area, and the Charlotte, North Carolina metro statistical area. So that being said, let's go take a look at the analytics for all three asset classes, A, B, and C together, and then we will look at each one individually. So let's go take a look at our analytics. So here is our supply side snapshot for the Charlotte MSA. There are 1,856 properties in this market, totaling 207,484 units. There is currently 26,630 units under construction, and over the last 12 months, 4,459 more apartments rented than went vacant in 2022 versus the prior 12 months in 2021, where 11,357 more apartments were rented than went vacant. We can see that in the vacancy, where a year ago vacancy was 6.6% and now it's sitting at 8.7%. We are seeing a year-over-year rent growth in this market. We will see what it looks like quarter over quarter. As usual, we are not looking at the capital markets. We are only looking at the space market. Okay, so anything dealing with the rents. As we scroll down and look at our long-term occupancy average over the last 22 years, we can see that that long-term occupancy average for this market likes to be around 92.69%, or let's just call it about 92.75%, and it's currently sitting at about 91.33%, so below that long-term occupancy average. All right, so with an occupancy of 7.5% or a vacancy of 7.5%, sitting currently at about 8.7%, I would venture to say we're probably going to be in the recession phase in this market, because we do have units under construction. Our absorption is slowing. Our vacancy is increasing, even though we have some rent growth happening, but we'll see what it looks like quarter over quarter. I think over the last quarter or so, we may see that this market has dipped into the recession phase for multifamily conventional apartments. But in order to tell for sure, we need to go look at our data and see what the data is telling us for all class A, B, and C combined. So here is the rent analytic data for the Charlotte MSA for all classes A, B, and C together. We do not look at asking rent. We don't care what the owner or the manager is asking for the rent. We only care what they are collecting. In the first quarter of 2022, we collected 1511, went up to 1585, and then the downtrend started down to 1571, down to 1538. So the fourth quarter had lower rents than the second quarter did, so it is definitely trending downward. Let's see if we can see what construction, deliveries, and absorption tells us, and see if that is acting appropriately. So we had 1,257 units delivered to the market and 1,314 absorbed. So good, strong absorption in quarter one. That explained that rent increase. Quarter two, we had 1,618 deliver and 1,608 absorb, so almost 100%. Again, really good, strong showing, and we see that in the occupancy, where that occupancy ticked up in the first quarter and stayed in the second quarter. This shows us that, but then we hit our inflection point. So 2,821 delivered, only 960 absorbed, and that did cause our occupancy to decrease. It also caused our rents to decrease in the overall asset classes, and then another 3,076 delivered and only 222 absorbed. So not a good showing over the last 2 quarters of 2022. Now, we can start to see our first quarter data. It's not the whole quarter, obviously, because we're still in the quarter, but our first month data is starting to show up. I want to wait a couple of more weeks because CoStar lags about 6 weeks in its rent data. And I'd like us to be in March before we actually look at a full set of January numbers. So I still don't think we can call the absorption here yet. And it looks like absorption did pick up and is keeping up with deliveries, but this is still a little premature. But let's see what it looks like as we get into March, which is only a couple of weeks away. So we're getting close to looking at this 2023 data, just not quite yet. So stand by, we're getting there. All right, so we can start to see the January numbers anyway. All right, so that's the overall asset class. The rents are reacting appropriately to deliveries and absorption. So far, demand, supply is reacting correctly. Let's see if it holds true for all 3 asset classes. Let's go take a look at our Class A's. So here is our Class A rent analytic data for the metro statistical area of Charlotte, North Carolina. There are 239 properties totaling 62,292 units. Looking at effective rents in the first quarter, it was at $1,764, went up to $1,863, and then started that downtrend. All right, and again, the Class A's, the rents are lower in the fourth quarter than they were in the second quarter, and honestly, they are just slightly above what they were in the first quarter. We could argue almost flat from the first quarter, so pretty much zero rent growth during this period. Now, when we look at year over year, it shows 3.2, and that is because we've had 1714 in the fourth quarter versus 1770, so that's where that 3.2 comes from. But we're only looking at 2022 data, okay? Once again, we're going to hold off for a couple of more weeks on 2023. Let's see what our deliveries and our absorption tells us. So it looks like we've got more deliveries happening in the B's than in the A's, but 266 delivered, 654 absorbed. That's a good, strong number, almost 3 times, okay? 922 delivered, 999 absorbed. Another great, strong number. This is the reason for the rent increases. So again, acting appropriately. But then we hit that inflection point. So 1562 delivered, only 574 absorbed. 1422 delivered, only 499 absorbed. So the occupancy did tick down, and you can see it is well below that long-term occupancy average at 89.7%. So even though we saw really strong absorption in first and second quarter, we saw really weak absorption, albeit not negative absorption, which I'm sure we'll see in the Class C space. But we had weakening absorption, which is causing those rents to go down. So again, the Class A market is reacting appropriately to demand-supply fundamentals. Let's see what story the B's are telling us. So here is our Class B rent analytic data. There are 695 properties in the Charlotte MSA, totaling 103,090 units. Looking at effective rent, in quarter 1 in 2022, we started at $1,476, went up to $1,545, then down to $1,539, down to $1,507. So far in all 3 data sets, the all combined, the Class A and the Class B, we saw this break point in between second and third quarter. I'm going to venture a quick guess here. I've not seen the data yet, but I will bet that it will be different in the Class C market because it has been in every other asset class. Now, the question I'm going to ask is, are we going to hold rent growth all the way through the fourth quarter, or are we going to see that break from the third quarter to fourth quarter like we have in some of the other markets? It's been about 50-50. But we have yet to see, I think there's only been 1 or 2 markets where the Class C's broke between the second and third quarter. Let's see what Charlotte does once we get there. First, we got to go look at our deliveries and our absorption. So we had 990 deliver in the first quarter and 736, so not as strong as the A's. 690 deliver in the second and 788 absorb, so a good, strong number there. As a matter of fact, occupancy ticked up 0.1% because of it. But then things start happening the wrong direction. So now we have 1127 and only 454 absorb. So that definitely is going to cause our occupancy to go down. Then we put another 1,396 units into the marketplace vacant, brand new, and another 225 go vacant on top of that. So very, very weak to negative absorption happening in the third and fourth quarter. So once again, the Bs are responding accurately to demand supply fundamentals. We have no demand, so the market rents are declining, and that's what both of these asset classes tell us, A and B. Let's see what that all-elusive C class is telling us, because we are still in the Southeast. Let's go look at the Cs. So here is our Class C rent analytic data. There are 686 properties in the market, totaling 40,605 units. Looking at effective rent, we started at $11.54 in the first quarter, went up to $11.95, went up to $12.12, and looky there, we had our break point down to $12.07. So it did break between the second quarter, or between the third quarter and the fourth quarter. Let's see what the absorption tells us, because we ignore any construction data in the Class C space. And as usual, we have negative absorption in all four quarters. As a matter of fact, we've got negative absorption going back 6 straight quarters. But here's where I'm going to throw a little safety margin here. We just went under 95% in the market, so we're at 94.2% occupancy. So the rents are starting to come down now, which means that the owners can't seem to handle, based on their NOIs that they need to keep, any occupancy below 95%. So they are now coming down on those rents because they've hit an inflection point of affordability. So the market is saying, you know what, we can't afford this anymore. So now we're going to start to roommate up. We're going to move back in with parents, move in with aunts, uncles, brothers, sisters, whoever. And that affects our demand. So that's what's happening here. But it's interesting that we've seen a few markets now where in the fourth quarter, we have that break point of affordability between the third and fourth quarter. And that seems to have been holding true over the last couple of weeks, where the first 4 weeks, the Class C rents were positive through all 4 quarters, even though we saw negative absorption trends like this. So I think that this pretty much confirms that, albeit slightly below that long-term occupancy average, kind of in between, much like the same market we saw yesterday in Minneapolis, Minnesota, where we plotted Minneapolis between that first point below the long-term occupancy average on the market cycle chart and the long-term occupancy average. I think we can do the same thing with Charlotte, although I would venture to say that Minneapolis rents were holding better than Charlotte rents are holding, but Charlotte is reacting appropriately to its demand supply fundamentals, where we have seen those fundamentals go out the window in some of these markets. So let's call it the Charlotte metro statistical area has entered the recession phase, albeit the very early entry of the recession phase. So we will probably see this pick up growth a little bit, especially with interest rates starting to escalate as quickly as they have in the last couple of weeks. That is really going to start to affect things. Stock market starting to go down. There's all kinds of things that are happening right now. So I don't know if that's an acceleration of what's to come, or if it will settle out like it seems to do between every time we have a CPI number that gets displayed. So we'll see how it reacts over the next month or so. And as we get into second quarter of 2023, we're going to start to see some interesting tales happen. So that does it for Charlotte. I hope this was a good one for you. Stay tuned tomorrow for their next door neighbor of Raleigh, North Carolina. So we're just going to kind of stay inside that triangle inside North Carolina. And then on Wednesday, we'll be doing Phoenix. And then, Thursday, we'll be doing Phoenix because today is Tuesday. And Fort Collins, Colorado will finish the week on Friday. So I will see you guys tomorrow when we do the Raleigh Metro Statistical Area.